Workers Union IG Metall negotiator Thorsten Groger.
Recently, the entire automotive industry was rocked by the news that Volkswagen, an 87-year-old empire spanning dozens of iconic brands, has officially announced unprecedented factory closures. VW's own chief financial officer, Arno Antlitz, issued a brutal reality check admitting, "Our house is burning." This decision puts up to 50,000 workers at immediate risk of losing their jobs. Overnight, Volkswagen's stock price plummeted by nearly half. Even its premium luxury powerhouses Audi and Porsche are deeply shaken by the fallout. If you think this is just another routine story of an automaker hitting a rough patch, you are completely mistaken. This implosion isn't the result of a single temporary misstep. It is the direct consequence of a decades-long pattern of arrogant corporate gambles repeated by executive leadership in Wolfsburg. Hit that subscribe button right now, because today we are breaking down the bitter truth behind this historic collapse. The financial domino effect. Volkswagen is entering one of its most grueling stretches since the Dieselgate emissions scandal. On the surface, the group still looks like an automotive titan, controlling Volkswagen, Audi, Porsche, Skoda, Bentley, Lamborghini, and many other major brands, with a massive 321.9 billion euros in revenue in 2025. But beneath the surface, the empire's financial health is rapidly decaying. According to the Volkswagen Group's 2025 financial report, its operating profit plummeted to just 8.9 billion euros, a staggering 53% crash from the 19.1 billion euros recorded the previous year. This dragged their operating margin down to a razor-thin 2.8%, down from 5.9% in 2024. This isn't a minor market correction. It is a flashing red light showing that while Volkswagen's massive machine can generate astronomical revenue, the cash it actually keeps after expenses has worn incredibly thin. Reuters described 2025 as a brutally difficult year for Volkswagen, as the group was hammered by punitive U.S. tariffs, cutthroat competition in China, and a highly expensive strategic overhaul at Porsche. In short, Volkswagen is still moving cars, but sales volume can no longer mask its mounting internal pressures. Even Porsche, the group's premium cash cow that historically anchored its high profit margins, was dragged down by cooling global demand and high restructuring costs. Meanwhile, the EV division continues to demand massive capital investments, even though the consumer market isn't accelerating as expected. Over in China, once Volkswagen's ultimate goldmine domestic giants like BYD and Geely are squeezing the German automaker harder with each passing year. With its operating margin squeezed down to 2.8%, Volkswagen has left itself zero room for error. A single additional macroeconomic shock, whether from escalating tariffs, volatile battery material costs, sluggish EV adoption, or further market erosion in China, could easily push this burning house completely over the edge, engulfing its factory's workforce and global supply chain. The root cause. The root cause of this systemic failure traces back to the Dieselgate emissions scandal. In 2015, the U.S. Environmental Protection Agency, EPA, accused Volkswagen of installing emissions cheating software in its diesel vehicles. This software could detect when the vehicle was undergoing laboratory testing. When triggered, it activated full emissions controls to pass the strict standards. But out on the real road, the vehicles pumped out NOx emissions many times above legal limits. The EPA stated the U.S. violation involved roughly 590,000 Volkswagen, Audi, and Porsche models from the 2009 to 2016 model years. Globally, the total number of affected diesel vehicles reached approximately 11 million. This wasn't just a technical glitch, it was a crisis of trust. Volkswagen had spent years selling the world an image of clean, powerful, efficient, and reliable German engineering. But Dieselgate stripped that away to reveal a completely different truth. When technical targets fell short, the corporate system didn't admit defeat. It chose to cheat using software, and the price tag was devastating. Volkswagen ultimately shelled out over $30 billion in fine settlements, vehicle buybacks, and mounting legal fees. Yet the financial damage wasn't the most dangerous part. The heaviest casualty was their reputation. Following Dieselgate, Volkswagen didn't just need to fix cars. They desperately needed a brand new narrative to bury their toxic emissions cheating image. And that is when electric vehicles stepped in as the perfect corporate smokescreen. Under the leadership of Herbert Diess, Volkswagen lunged into a massive aggressive electrification strategy. The group announced an investment plan of approximately 180 billion euros for the 2023 to 2027 period. More than two-thirds of that astronomical budget was strictly earmarked for electrification and digitization. It sounded incredibly green. It sounded like the future. But the question that must be asked is, did Volkswagen truly chase EVs for the consumer, or did they just need to wash away the diesel stains from their past? The problem was that the entire strategy was rushed. CARIAD Volkswagen's in-house software division rapidly degenerated into a massive cash-burning black hole. Glitchy software delayed the ID.3 and severely set back the launches of the Porsche Macan EV and Audi Q6 e-tron. After burning through billions for years, Volkswagen had to look to Rivian for rescue. In November 2024, Reuters reported that Volkswagen increased its financial commitment to its joint venture with Rivian to $5.8 billion to co-develop electrical architectures and software. That is no longer technological independence. That is emergency damage control. And when the ID lineup finally hit the market, consumers were far from impressed. The ID.4 plummeted in the US market the moment the $7,500 federal EV tax credit dried up. Automotive Manufacturing Solutions noted that Volkswagen completely halted ID.4 production in Chattanooga to shift the facility's capacity back to the gas-powered Atlas SUV. Therefore, the root cause isn't that electric vehicles suddenly failed on their own merits. The real failure lies within a corporation that once used software to mask the ugly truth inside its diesel engines and then attempted to use electric vehicles to mask an entirely different reality. The corporate paradox. And when profits tank, they fall back on the same old playbook, used by every massive corporation. Cut costs, lay off staff, close factories, and brand it as restructuring. But for Volkswagen, this goes far beyond a mere financial decision. It is a direct strike against German society, the working-class industrial towns, and the very customers who once believed Volkswagen was the ultimate symbol of stability. In 2025, Volkswagen still generated roughly 321.9 billion euros in revenue, but its operating profit plummeted to just 8.9 billion euros, a staggering 53% crash from the previous year. This dragged their operating margin down to a razor-thin 2.8%, forcing the group into an extreme financial defense mode. To salvage those numbers, Volkswagen took the easiest way out. They cut people. Reuters reported that the group aims to slash approximately 50,000 jobs in Germany by 2030 as part of a massive restructuring plan to cut costs and revive profit margins. The problem is every single laid-off worker is more than just a data point on an Excel spreadsheet. That is a family's rent. That is a child's tuition. That is a mortgage payment, health insurance, utility bills, and the entire future of local towns that survive solely because of a Volkswagen plant. When a titan like VW cuts tens of thousands of people, the domino effect doesn't stop at the factory gates. Suppliers lose orders. Diners around the industrial parks lose customers. Contractors lose their livelihoods. Working families freeze their spending. An entire community is dragged into a state of deep anxiety. That is why the outrage from the workforce isn't just about losing a paycheck. It stems from a profound sense of betrayal. Because the workers didn't cause the $200 billion disaster. They weren't the ones who decided to ship Golf production to Mexico or let the ID.4 fail in the US market. Yet when the bill arrives, they are the ones forced to pay the price. Even the iconic Dresden Transparent Factory, once a glowing symbol of Volkswagen's industrial pride, was shut down after 24 years of operation. The final car rolled off the assembly line on December 16, 2025, marking the end of a journey that spanned from the Phaeton and e-Golf to the ID.3. For car buyers, the resentment is just as fierce. They see a corporation that hiked up vehicle prices, stripped away the emotional and material quality of their products, and aggressively pushed customers toward overpriced, unconvincing EVs. Then when that strategy blew up, instead of slashing prices, fixing the product, and taking accountability, Volkswagen chose to slash jobs, outsource production, close plants, and call it optimization. Meanwhile, the corporate paradox sits squarely in plain sight. Volkswagen's automotive division still generated a healthy 6.4 billion euros in positive net cash flow. The money is there, yet the people asked to sacrifice first are the factory workers. German media outlets reported that CEO Oliver Blume still pulled in roughly 7.4 million euros in total compensation, while former CEO Herbert Diess, the architect who drove the chaotic EV gamble in the first place, was reported to receive around 11 million euros. So where's the fairness? When the strategy wins, executives pocket massive bonuses for their vision. When the strategy fails, the workers get fired to cut costs. Scout Motors, the ultimate desperate gamble. So what is Volkswagen's escape route? Instead of addressing its deep-seated internal root causes, VW is choosing a path that feels like self-sabotage. Enter Scout Motors, Volkswagen's most aggressive and incredibly reckless gamble in the United States. After acquiring Navistar, Volkswagen secured the rights to Scout, an iconic American off-road nameplate originally born under International Harvester. But instead of integrating Scout into the existing Volkswagen pipeline as a standard model lineup, the corporate brass spun it off into a completely separate company. On the surface, it looks like a clever branding play. In reality, it looks like a highly calculated corporate loophole. Volkswagen is attempting to sever any legal connection between Scout and its existing VW dealer network to test the one business model U.S. dealers fear most: direct-to-consumer sales. Scout recently unveiled its Traveler SUV and Terra pickup concepts, taking direct aim at the American obsession with rugged trucks, off-road performance, retro aesthetics, and utilitarian capability. But the real bombshell isn't the sheet metal or the retro design, it's the retail strategy. Scout openly announced plans to sell its vehicles directly to buyers online and through dedicated company-owned showrooms, bypassing traditional franchise third-party dealerships entirely. Unsurprisingly, the dealer network immediately declared war. TechCrunch reported that a group of Florida-based Volkswagen and Audi retailers slapped Scout Motors with a lawsuit to block the direct sales strategy, arguing that Scout is nothing more than a corporate shell entity deeply dependent on the Volkswagen Group. Car and Driver also confirmed that this legal challenge targets both the legality of the direct-to-consumer architecture and Scout's broader operational authority within Florida. Over in California, the battleground grew even hotter. Motor One noted that the California New Car Dealers Association fired off a formal demand letter insisting that Scout and Volkswagen halt their direct sales rollout, claiming the model flagrantly violates strict state franchise protections. By 2026, the legal warfare scaled up as 14 California Volkswagen dealerships filed formal protests with the California New Motor Vehicle Board. Meanwhile, a major class action lawsuit was slammed against VW in a Virginia federal court on behalf of nationwide dealers following a massive wave of over 150,000 online reservations that skipped traditional showroom floors entirely. For these multi-generation dealer principals, this feels like an absolute betrayal. They have sunk millions of dollars into erecting state-of-the-art showrooms, hiring local staff, training specialized diagnostic technicians, and carrying the VW badge through grueling sales quotas. Yet the parent corporation went behind their backs to build a rival brand specifically designed to freeze them out. If Scout successfully executes this blueprint, it will trigger an absolute nightmare scenario for the franchise dealership lobby. Every major automotive legacy giant will copy the playbook. Ford, GM, Stellantis, Hyundai, or Toyota could effortlessly launch an independent sub-brand, spin off a corporate shell, or isolate a new EV line just to cut out the middlemen and maximize profit margins. If that happens, the traditional dealership system won't just lose a few hot vehicle allocations, it will lose its entire reason to exist. Bloomberg documented this escalating civil war, highlighting that U.S. dealers are aggressively suing Volkswagen for what they deem an illegal conspiracy to intentionally leave their multi-million-dollar showrooms completely out of the equation. This massive internal revolt has escalated far beyond a simple product dispute over a new electric SUV or pickup truck. It is an all-out existential war to decide the future of how cars are sold in America. Under siege in the U.S. and China. Volkswagen scraped together minor growth in Europe, but that couldn't bandage its two deepest wounds, the US and China. The group delivered 8.98 million vehicles globally in 2025, a slight 0.5% dip. On paper, a fractional drop sounds fine, but break it down by region and the real damage comes into focus. While Europe ticked up 4% and South America jumped 12%, North America plummeted by 10%, and China sank by 8%. VW kept the lights on in smaller markets, but completely lost its footing on the two most critical battlefields on Earth. In the US, VW was squeezed by a vice grip of macroeconomic pressures. New tariffs made importing and local production brutally expensive. Worse, when federal EV tax credits ended, electric vehicle demand froze. Ars Technica reported that ID4 sales in the US cratered by an incredible 62% in the 3 months following the loss of that $7,500 subsidy. VW was forced into a humiliating pivot, halting ID4 production entirely at its Chattanooga, Tennessee plant to free up assembly lines for the gas-powered Atlas SUV. Some trackers even reported the ID4 moved a pathetic 248 units nationwide in the final quarter of 2025. That isn't a sales slowdown, that is a free fall. Over in China, the impact cut even deeper because this market was VW's ultimate cash cow. The automaker reported that its battery electric vehicle EV sales in China crashed by 44% in 2025, even as its global BEV baseline managed a 32% bump. Reuters confirmed that by the close of 2025, VW dropped to third place in overall Chinese market sales, watching local challenger Geely cruise past them into second after already surrendering the crown to BYD the year prior. This was a psychological shock to the system. BYD, Geely Neo and XPeng weren't just undercutting the Germans on price. They were building smarter cars, pushing out software updates, faster packing, in cutting-edge tech, and tailoring the vehicle ecosystem perfectly to younger Chinese buyers. In a desperate bid to claw back relevance, VW is pinning all its hopes on its In China for China strategy, spinning up local vehicle development and localized supply chains on Chinese soil. But make no mistake, this is no longer the offensive posture of an industry titan. This is the frantic survival reflex of an empire forced to sprint just to keep pace with the very market that used to feed it. Conclusion. Ultimately, Volkswagen's fate no longer hangs on a new electric model, a shiny new factory, or a polished green slogan broadcast to the media. Looking at the bigger picture, the story of Volkswagen serves as a stark warning to every single automaker currently resting on its laurels. Do you think Volkswagen can still pull off a rescue mission? Or is this just the opening chapter of a much larger collapse? Drop your thoughts in the comments below. Hit like, subscribe to the channel, and turn on the notification bell so you don't miss our next deep dives into the automotive world.